Welcome, ladies and gentlemen. Hey, I'm Andrew D'Amico. Sorry, where are my manners? Uh, um,
The cool accountants.
I'm Andrew D'Amico, partner here at Ledgerly. I'm an accountant. Guilty. I bet you could figure that out. Been practicing accounting for 7 years, been licensed CPA for 2, and I'm here with my good friend, co-host, partner, and incredibly bald and handsome friend, Mike Abrahamian. Please.
Hey, at least I only have my regular glasses on right now, but should have had my shades on for this one. Hey, everyone, thanks for tuning in. Some exciting topics today. First of all, we're shooting this at the beginning of November, so we're getting into the holiday season, Thanksgiving, Christmas, whatever religion you guys celebrate, holidays you guys celebrate. We just want to wish you happy, healthy holiday season from us here at Ledgerly. And we have some pretty exciting topics that we want to talk about getting into year end here with my incredibly handsome co-host, Andrew D'Amico, CPA. Also, Mike Abrahamian, CPA.
That's 2 CPAs in one package, in case you weren't counting at home or you don't know how to count.
Yeah, we're 1, 2. Oh, yeah, you're right. Okay.
Not to dive in on our backstory, but both products of Stonehill College. That's where we first started collaborating and studying the accounting practice, the accounting industry, the accounting principles, which is its own language.
Yes, sir.
But enough about us. Let's get into you. And we're going to give you here 5 subjects, topics that we think are really going to move the needle and you should really keep in mind ahead of the year end. Again, recording beginning of November. Let's see when we roll these out, but they apply every year. And just because we're talking about them now ahead of the year end doesn't mean they need to be addressed in the next 2 months. They can be addressed next year. Now, do we recommend that you address them in these next 2 months? Of course, but it's always something to keep in mind. But we think these are some of the most important.
Yep.
Again, date of this recording, it's early November, 2 months before the end of the year. And I want to start with probably, I don't want to say the easiest, and I'm not going to say it's complex or there's nuances to it, but I think it just gets pushed to the wayside for a lot of people. And that's just keeping up on your bookkeeping.
Oh, yeah.
Obviously, we're out there. I'm speaking primarily to business owners who either started last year, 2 years ago, or have been in business 20 years, but are that type of person that just pushes it off, doesn't give it any attention. Bookkeeping is important because it's going to allow you for better insights and allow you to actually set up a plan for tax savings.
Mm-hmm.
How do you know what's going on? How do you know what to do if I were to ask you a question as a business owner, like, oh, what's your bottom line? Or like, how much are you bringing in? And you can't tell me?
I can tell you what's in my bank account. Oh, it doesn't tell us anything. I mean, it all starts. We pound this to death. We beat it to death. It all starts with the bookkeeping. It all starts with good, clean records. As a business owner, especially, we can't do efficient tax strategy for any of our business clients without accurate bookkeeping. So yes, bookkeeping is the foundation. It's the bottom of the pyramid. It's the basement of the home. It is building your. That's where you build your. That's what you build off of. So yeah, having your books in order for year end is going to help you and us do effective tax strategy, tax planning, generational planning, asset protection, all that fun stuff. It's a pretty simple topic. Debits and credits, money in, money out. It's really it. But yeah, having your books in order just makes it seamless, flawless, easy for you, easy for us. Andrew, do you like to do bookkeeping?
I know where you're going, but I actually want to back it up before we go on that. So I know Mike just said all great points, great analogy. Few things on that. I know he said it's very simple, debits and credits. If you're listening to this and you're that business owner that's doing their own books and they don't know debits and credits, that's fine. I wouldn't expect you to. If you're in the construction business, like, I don't expect you to be behind your computer in QuickBooks and saying like, all right, that should be a debit, that should be a credit. Like, oh, I need to make a journal entry. Like,
right.
Like, the reason there are bookkeepers in the world, there's CPAs to do the bookkeeping, to understand the language of accounting, which is primarily debits and credits. Like, leave that to us. Outsource what you're not good at. I know I'm going on a little tangent here, but That's what people like Mike and I are here for, to make things simple for you so you can focus on what's important in your business and growing that top line and minimizing that bottom line, within reason, so you keep money in your pocket, but you're still getting as much money as possible.
Absolutely. And I apologize for that. I just threw out some accounting terms that maybe some of you don't know and some of you may know. But think about it as money coming into your business and money going out of your business. The money coming in, is it revenue or is it a contribution that you're putting in as an owner? Two totally different things that we will help you navigate. Money going out, is it an expense? Is it an owner distribution? What is it? Again, things that will help you navigate. But having that broad view of knowing what's coming into your business, what's going out of your business, is it income? Is it an expense? Is it a balance sheet item, meaning your assets like your cash, your receivables, your liabilities like your payables, and then equity, what you own in the business. But when it comes to bookkeeping, I don't want to go back to the question I asked you, but do we? Well, finish. You make your points before we get into how much we love bookkeeping.
Because there was another. No, Mike made some great points there, but one I wanted to circle back to. Okay, I'll answer your question. So, do we like to do bookkeeping? No, and I'm not going to sit here and say it's a waste of time, because it's not. It's important to have good and accurate bookkeeping, because how I started this topic, how else are you going to plan? How are you going to make a plan? Let's say, I know I'm not going to go through a big example, but like you have $100,000 coming in. How much of that is, like Mike was saying, is that a contribution? Was that monies from a customer? That's why you need to have an engaging relationship with your bookkeeper, or you as the bookkeeper, or your outsourced bookkeeper, or us as the bookkeeper. Whoever is the one booking the transactions, they need to know what the heck is going on. If you don't talk to them and they keep sending you questions like, hey, I noticed, 100 transactions is bringing in like $150,000 that went into your business bank account. Are these from clients? Are they from you? Are they a combination of both? If you don't answer them and, they're sitting there in January, February, March, and they're like, frick, client X never got back to me, I don't know what to do. They're probably going to go the safe route and book it all to income.
Right.
And that's higher taxable income for you, which means
more tax, more money out of your pocket as the hardworking business owner.
So just to tie back into that first point, bookkeeping, accurate records, accurate books are important, because it's going to play a huge factor in your taxable income at the end of the year.
Yep.
And if it's accurate through the year, and you have a good advisor like my good friend Mike and myself, I'm decent.
Yeah,
decent at best. The point being, we could do better tax planning for you. Which, heck, you want to segue to the next topic? Yeah, I'm gonna go there. Any other points on bookkeeping?
Oh yes, I do. Okay, so and then let's go to the next topic. So obviously, bookkeeping, it's not sexy. It's not the sexiest topic when it comes to accounting is not sexy, right? But you know what's sexy?
We kind of make it sexy. He works out,
I think that's just us. I think it's just us.
Yeah.
We ain't your typical CPAs. No. I mean, we're at Foxwoods Resort and Casino. We're gonna go pound steaks. We're going to be drinking tonight. We got our client fighting.
I don't know if we want to be advertising the drinking part, but like there might be something other than water in these nice Ledgerly Yeti mugs that you see.
Yeah, it's seltzer water.
True. That's a part of
it. Let's just say work hard, play hard, and that's how a business owner should operate.
Yeah, that was my motto in college.
Work hard, play harder. Bookkeeping is not the sexy, like when it comes to accounting, to take a step back. Accounting isn't the sexiest, but you know what is sexy? Building generational wealth, saving tax dollars, keeping more in your pocket, and it all starts with the bookkeeping. So having a good advisor in your back court, like our advisory services, will handle your bookkeeping for you. And it's good because one-stop shop, bookkeeping, tax strategy, tax return, rinse, repeat, and the whole thing. Sorry, that was not the point I wanted to make. What I wanted to say is, I'm going to rewind. Let's do a little case study here. I go to you, Andrew. Hey, I'm a brand new business owner. I just set up my business. I did my IRS documentation. I did my state documentation. I did the BOI, the beneficial ownership reporting with the corporate transparency. I did all that stuff. Now I'm ready to go start making some sales. I want to start generating revenue. What do? I don't know what to do now. I don't have do I need a business bank account? Do I need quick, like, can you help me? Can you help me navigate this, Andrew?
You full well know what you have to do.
Let me
But
take some notes.
in the case study, Mike's going to pull up the iPad. But Mike, as the client here, is going to come to his advisor, and what am I going to tell him? The important thing. So he just alluded to it. You're going to go into a bank, whatever bank you want. You go to Chase, you go to Bank of America, Wells Fargo, whatever bank you want that's convenient for you. I'm not going to sit here and throw out recommendations. It's just whatever you're most comfortable with, because at the end of the day, it doesn't really matter. But go to a bank and set up new, separate bank accounts that's going to hold all of your business activity. We've been talking, right? Money's coming into the bank account, and then us or your bookkeeper is going to say, like, hey, where are these monies coming from? Is it a client or is it you? That's just going to make this whole process 10 times easier. Because if you're handling your business activity through a personal account, I mean, depending on the level of personal spending you're doing or business activity you're doing, it could be 90% personal, and your accountant's trying to fish through personal bank statements. Like, that's a nightmare when he's looking for 10% of business in that account. So yes, you get all the docs set up, you get formed with the state that you're operating in, you're going to go to the bank, you're going to bring those documents, they typically require them, and you're going to come ready with, again, depending on the bank or the account you're going to set up, you're going to have $500 ready to deposit, or $1,000, or maybe it's only $200, or maybe it's free. But typically they'll require your entity documents and some form of ID, and money's ready to deposit and open the account. So that's step one. Then step two, he also alluded to it, you're going to want to track it somehow. We at Ledgerly, this isn't an advertisement, but QuickBooks is incredible. QuickBooks Online especially. You can go ahead and set up a QuickBooks Online account. I think the cheapest subscription for clients is like $30.
I think it's like $40 now, but regardless, it's 30 or $40. It's
a month. So $10 a week, you're going to be just fine. Like, you'll live. But you go ahead, you set up a QuickBooks Online account, and then you are going to find a bookkeeper, because again, we want accurate books. So let's make sure we're keeping them accurate, and the bookkeeping is done appropriately and accurately throughout the entire year. Not all done in one shot when you go to a CPA in January, February, March. That's not when you want to do it. You want to do it as soon as you're starting your operations and you get that business bank account set up. You get a bookkeeping software. Again, I said QuickBooks. You're going to link your bank accounts, and then that's going to pull in all of the business activity, because when you go to clients, when you pay vendors, it's going to be all through your business bank accounts. Keep business and personal separate. So there is no question, was this a distribution you paid you pulling money out of the account? Was this you funding money into the account? We don't want any confusion. We want it cut and dry. This is all just getting to accurate books. You get the QuickBooks set up, you hire us, you give us remote online access to your QuickBooks, and then we manage it for you remotely, and then it's pretty simple from there. We take it and run from it there. I'm sorry. I know that was long-winded. Does that help answer your question?
Okay, so just to recap, as a client here, I'm not Mike from Ledgerly right now. Right now, I'm Francois.
Incredible name.
It is. My God, just pulled that out of the air. So, Francois, I'm a chocolatier. Okay.
You do not look like a Francois, for the record. But
if I had just the mustache, I think I would.
Is that French?
It's okay. French, yeah. But
Francais.
En français. I'm going to stop now, and now I'm going to go back into the mind of Francois and say, okay, Andrew, that all makes sense. So I started up my LLC, so now I can take those documents, the EIN from the IRS and the state documents, and bring them to the bank and open up a business bank account. So a business bank account, and can I do a credit card too?
Of course.
Okay, so business bank, business credit card, only business related, no personal will go through there, right? Unless I'm taking it out personally to pay myself.
Yeah.
Okay. And then I'll set up a QuickBooks account. But it costs $30 or $40. Is there anything cheaper that I can get?
I'm glad you asked.
I'm taking notes.
This is ridiculous. I don't like calling you Francois, but Francois. Yes. So, like us, we are QuickBooks Pro Advisors. We are in their Pro Advisory network. So what QuickBooks has is they have this directory where, like we're saying to you, when you don't know how to do the books, you don't have any accounting background, you don't know debits and credits, you can actually go into that directory and search whether you want to do it by zip code or you don't care if they're remote. Point being, you can go to this directory, search up pro advisors. They're not all CPAs, which not saying somebody that's not a CPA can't be a good bookkeeper.
Yeah, there's plenty of great ones. All right, I'm Francois. I don't know anything right now.
Yeah, shut up.
Okay.
So point being, like, QuickBooks has their own like testing process to make sure that like people they're putting in this directory kind of know what they're doing. So they have to pass a test every year in order to be listed in the pro advisory directory. You go there, you can click on someone, you click on Mike, you give him a call, and he's talking you through everything. He, as a pro advisor, can set up your QuickBooks for you. So Francois doesn't want to pay $40 a month. I get it. Maybe you're just starting operations. You're trying to cut costs as much as possible. Okay, that's fine. So we can actually do what's called QuickBooks Ledger. It's a new subscription they came out with probably within the past year. And the pro advisor sets up the account, and they actually pay for it on your behalf, $10 a month. And then they set up some sort of reimbursement with you. They'll get you on a recurring ACH to debit your account for $10 for the reimbursement every month. But you can see it's like $360 savings. Difference between the $40 minimum subscription that Francois has access to. But when you go through a pro advisor, they have access to this QuickBooks Ledger account. And the reason it's cheaper is they pull out some of the functionalities. But if you're just opening up operations for the first time and activity is minimal, Ledger is probably going to be appropriate for you. Again, there's no one size fits all. It depends on your business, whether you're selling products, services, if you're a C Corp getting a lot of money from investors, or if you're just opening up your own single member LLC and just funding it with your own personal funds. So it's going to vary whether Ledger is going to be appropriate for you or not, but it's an option, Francois. And you can go that route.
This is great. This is great info. So start up the LLC, business banking credit card, QuickBooks Ledger for $10, which isn't bad, $120 a year about. And then, okay, Andrew, if I have your team at Ledgerly do my books, then you have a hindsight view of my books throughout the year.
The entire year in real time.
And that means that I don't need to be concerned about my tax strategy because you guys are doing my books. So we can set up tax planning calls too and know what to do for year end. Is that what I'm getting?
Absolutely.
Oh my gosh. Where can I sign? I want to sign up now. Can I just sign this and sign it over? All right. All kidding aside. Yeah, you freaking knocked that out of the park. That's it. That's 3 basic steps. LLC, business bank and credit card, and set up an accounting software, QuickBooks. One thing that you mentioned, business and personal. Obviously, we need to separate it because it makes it tougher for you and us to go in and be like, what's business, what's personal? But commingling business and personal, that pierces the corporate veil, especially if you're an LLC or an incorporated entity. Pierces the corporate veil. It is technically makes a legally binding document null. If you got pulled into court for not tracking expenses, receipts, and whatnot, and you had personal and business mixed into one account, tax attorney or whoever's in court might just say, yeah, you didn't have everything separated, you pierced the corporate veil. Because as an LLC business owner, you have the due diligence to make sure that everything is in order and separate from your personal life. Yes, you're a disregarded entity. It flows through to you personally, but it needs to be separate. So these are 3, I think they're 3 it's not like debits and credits where that's complicated. 3 fairly easy steps where it's LLC, business banking credit card, set up an accounting software. Number 4 is hire Ledgerly, I guess.
What do you mean you guess? You know that's the answer.
Well, I didn't want to give them, I don't want to throw
not to force your hand, but
didn't want to throw this kitchen sink, but
you will regret not hiring us. I could tell you that much.
And this is why good bookkeeping leads to effective tax strategy, because there's no questions asked at the end of the day. You're in a good spot with us. And as long as they're doing effective tax strategy work, you're golden. I mean, what can be better? Thank you, Andrew, coming from Francois, for introducing me to that.
So Francois brought up Sorry, the drinks hit me. Francois brought up
Spindrifts are good.
something that we're going to dive into right now. So, you get everything set up. You're a new business owner. You get a bookkeeper to handle your bookkeeping through the entire year. But you get a one-stop shop like Ledgerly. We're going to do your bookkeeping. But then Francois was like, does that mean we could do tax planning calls throughout the year? Yes, absolutely. And this is one thing that Mike and I were talking about with other professionals in the industry that you might have right now. Of course, obviously, we don't handle every single bookkeeper or every single business owner's books and tax planning. Obviously, there's a lot of you out there. There's a lot of people in the U.S. with their own side hustle, LLC, business. There's a lot more now than there's ever been. So this part's important, tax planning. Is your current accountant doing tax planning or tax strategy? Those are two different things. If they're coming to you and saying like, yep, hey, send me your most recent or your quarter's, P&L and any other relevant income that you have in your entire picture, and I'll give you quarterly estimates. And he calls that tax strategy. I don't want to hog the mic.
That's not tax strategy.
I don't want to hog the mic.
No,
Mike, like tell the people why that is not strategy.
So wait, hog me or hog like the mic? Never mind. All right. So I'm okay. Yeah. So as Andrew's saying, exactly. Your current accountant is saying, "Yep, give me your P&L. What your W-2 look like. Any other 1099 income. Let's do quarterly estimates." That's not tax strategy. That's tax planning, I guess. I mean, it's not even really planning. It's really just doing math to see what you owe.
So as a business owner, you might be familiar with you start a business and then people tell you, "Oh, you got to make sure to start filing your taxes quarterly." And then you go to your accountant like, "Oh my God, I got to file taxes quarterly. I don't know what to do. Please tell me what to do." And then that's when, what do we want to call him? Accountant B or B class accountant?
Oh, I thought you were pointing at me.
No. Just like these people that are saying that they're doing tax planning. But point being, this accountant,
if your accountant has a red well, if they use paper, if they work in paper and have red wells in your client files, then yeah, it's probably accountant. Yeah.
I hope they see this. So, point being, quarterly estimate. So you don't file your taxes quarterly. You pay in quarterly estimated income tax payments.
Right.
So what they're getting at is the difference between a W-2 earner and a business owner. A W-2 earner has withholdings on every single paycheck because what the employer is doing is saying like, hey, so obviously anybody in the workforce knows this. Like you get hired to a new job, like, oh my God, that's great. I have a $150K salary. You full on well know you are not going to see $150K hit your bank account by the end of the year. That's not how it works. That's where withholdings come into play because the employer is withholding those monies from you and they're remitting it to the IRS, to the state that you're in. And they're making those estimated tax payments on your behalf with the money you earned. You just never see it. As a business owner, it's up to you to physically write a check to the IRS,
right?
Write a check to the state you're in if you're subject to state income tax.
Right.
How do we segue back that into? Okay, so now you're a new business owner. You need to make these quarterly estimated payments.
Mm-hmm.
And your accountant knows that. Okay, oh, you're a business owner? All right, send me your P&L. I'll get you a calc. I'll tell you what you got to pay. That's not planning. That's just making sure you don't have to make one large balloon payment at the end of the year, and it's going to avoid any interest and penalties because the IRS and the states do require, again, states that are subject to state income tax, they require those quarterly deposits because they want a piece of the pie throughout the year. They don't want it all in one shot at the end of the year. They're saying like, no, Q1 you earn $50K. Like I want a piece of that. Fork it over.
Yep. So
that's where the accountant is coming in and saying like, yep, give me your income so I can calculate it for you. And they're going to come back and say like, yep, pay in $10,000. And let's assume a very simple example. They're going to do this 4 times throughout the year, and every time they come back and say, yep, pay in $10,000, pay in $10,000, pay in $10,000. At the end of the year, you have $40,000 in payments. They file your tax return. Your income tax liability is $40,000, but you just paid in $10,000 a quarter. 10 times 4, 40,000, liability, $40,000, net $0. You owe zero at the end of the year. They do that opposed to waiting until the end of the year to make your payments, and you see your tax liability of $40,000, and then making $40,000 all at once. Because in that as well, you're incurring interest and penalties because you didn't make those quarterly deadlines. Did I talk too much, or does that make sense?
No, it makes perfect sense. So I think we would I'm going to back it up for a second. Andrew mentioned W-2 employee versus a business owner, 1099. One thing, and this is kind of like not off topic, but in a sense, if you're a W-2 employee, you get money that hits your bank account after taxes. So it is your gross minus taxes, and then whatever's left, you have to live on. You have to pay your mortgage, your rent, your insurances, your car, all your payments. As a business owner on the 1099 side, you get to do all of those expenses before you pay tax. And the tax strategy, that's where that comes into play, where we have a list of 20 to 25 great tax strategy points where we would encourage you. Right now, our calendars are filling up for an hour consultation to go through. If you're a business owner, W-2 employees, if you have a side hustle, then get in touch with us. Or if you're a high income W-2, get in touch with us, because there's tons of great strategies for business owners, people with side hustles, and high income individuals for W-2s to take advantage of this list of 20, 25 strategies that we have. Some of them might not be applicable. Some of them will be applicable. But you won't know unless you book the call with us and pay us what do we charge? $750 for an hour for that?
Yeah, $750 for an hour.
And if you don't find value in that, or if you can't save at least $750 or 2, 3, 4, 10x that, we just refund you the call in full. I mean, that's...
Mike, how long have we been in business? 2 years, give or take?
How long is Ledgerly?
Ledgerly is 2 years. 2
years. How long have we been working together now? 6, 7?
I was going to say, for sure, at least 5. Yes, yeah. Probably 6.
Yeah. I mean, I'm old. I'm 30.
He's not 30. He's almost 30.
I mean, when they're watching this, I might be 30.
He is old. He is bald. But we love him. And he is smart. But I bring up the time because in those entire 5, 6, 7 years, we have not had to issue a refund check. We know what we're talking about. Yes. Does it seem, oh my God, $750, or you get it for a comprehensive consult, $1,500? Yeah, it sounds like a lot, especially if you're just currently paying your bookkeeper or your accountant for bookkeeping and maybe a tax return. And then you come to us and we're going to advise you and give you actual strategies that you can implement and see a change in. It's something different. It's something your last accountant never did. So you don't understand the value, and you see that, $750 for an hour, like, oh my God, that's crazy. That's too much. There's a reason it's that much, because you're going to see even more than that. Listen, we're not monsters. We're not here to steal from anybody. We're here to provide value to you.
Yeah, that's most important. But, and I will say this, like the last one, the big hairy butt. No. If you are a taxpayer that's like, you know what? I just want to pay my fair share. I just want to know what I need to pay. Andrew and Mike take care of it for me. It's not rocket science to calculate what you owe. And at least I think we have 2 different types of calculations. If you just want to take a percentage of what you made and pay it to federal or state, if you live in a state that has income tax, which is most of them, what we recommend is, if you're a business owner, 10% of your top line, your gross income, meaning the monies that came in before you paid out any expenses, take 10% of that each quarter and pay that in. Federal, maybe split it 7% federal and 3% state, something like that. I'm giving free advice right now because we're so confident in our tax planning. So
yeah, I don't like how you're giving this to them for free, but I'll let you cook.
But it's because if they just want to pay more tax, then that's fine.
Like, yeah, exactly. That's entirely up to you.
Go for it. You don't want the strategy? Fine. Take 10% of your gross number, or take maybe 30% of your net income, meaning your
after you've paid all those expenses,
all your operational expenses before taxes, your EBITDA, if you will,
if you're familiar.
If you're familiar, yeah. not going to give that one out for free. 30% of your EBITDA, maybe 20% federal or 10%. I mean, you have a copy of your last year's tax return. You know what tax bracket you fall in.
Yeah, you could even
look at that tax bracket.
You could even dumb it down more than that. Like, you don't even have to go into the brackets and everything. Just look at what you did last year, and if this year is similar, just look at your income tax liability at the end of the year at the federal level, at the state level, divide it by 4, pay that in each quarter. Now, is that perfect? Of course not, but it's a fair estimate, and it's going to safeguard you, and you're not going to be jacked up with penalties and interest for underpayment of one quarter. It's not going to kill you. And probably, maybe, you end up with an overpayment. Maybe you're that type of taxpayer that's, oh, yes, I just want to be compliant. I don't care. Take the money. You can credit that to the next period.
Right.
And, safeguard yourself. Or if you operate under our mindset and what we tell our clients, we don't want to give the feds, the IRS, an interest-free loan. That's your money. You should hold on to it. You should aim to pay in just enough to keep them off your back, because that's money. That's your money. Don't give it to them and have them hang on to it. That money could be working for you in an investment, reinvesting back into the business, paying kids.
Amen, brother.
So much to go off that, but that's my take.
Can I end this topic on just one point? If you want to pay the quarterly estimates, that's fine. It's not rocket science. It's just math. Just take the percentages, like I just said, 10% of gross, 30% of net, allocate it that way. If you want tax strategy, please get in touch with us. Because like Andrew said, we are for the small business. We're not for the government. So we're working for you. We're not working for the IRS or the state. If you are a hardworking individual who is, I want to set generational wealth, I want to make sure I'm ready for retirement, I want to make sure that I don't need to worry about all things money, let's have a conversation, because we want to help you. But if you want to make quarterly estimates and not have to worry about anything, that's fine too. Mike and Andrew do quarterly estimates. That's fine. We'll do that for you. But in our good faith, we want to help you as much as we can. So that's, I think, that's a big thing.
You got to meet us halfway. We're not going to give this stuff out for free. Listen, we're small business owners ourselves. We're here to help you. But at the same time, our information is so incredibly valuable, and we undervalue not going to curse. We undervalue it. We sell it to you much less than what it's actually worth.
Oh, absolutely. Hands down. It's insane.
And why do you think I said before? Been in business 6-7 years and never had to issue a refund check. There's a reason for that.
Right.
And again, if you're just listening, you clicked on Ledgerly, you're seeing Mike and myself for the first time, I get it. You might be skeptical. And again, it goes back to the point, you're paying your current accountant, X, and you would be paying us 2X. There's a reason for that. What are they doing for you? What are we talking about that we can do for you? Put some faith in us, and we'll put the money back in your pocket. Guaranteed. I promise you.
Yep. Planning is not strategy.
So that was a good bow to put on that topic. Yes, so that was a huge divulsion, if that's a word, into the difference between planning and strategy. If accountants selling planning and it's just quarterly estimates, they're doing planning, but it's not strategy. They're not helping you. They're just trying to get you out of interest and penalties, which is fine. But we're not going to go down that road again.
Kind of like what we said, like when you're a business owner, you have your income that comes in, then you have your expenses, then you have taxes. Let's make it so it's income, expenses, strategy, and then taxes. So if there's anything left after we incorporate all those great strategy pieces, those 20, 25 strategy pieces, whatever's left, yeah, you'll have to pay. But it's going to be substantially less than what it would have been, and marginal versus our fee. So
marginal. If you don't know what that means, look it up.
No more free advice, like that's what I call it. Yeah, let's put a bow on that one.
So speaking of tax planning, tax strategy, we're not here to talk about quarterly estimate calculation. But one of the strategies, and it's just so pertinent, at least for us right now, we're going to show you how to do it live, is travel.
Oh, huge.
You hear us talk about shifting when you become a business owner, this isn't fraud by any means, but it becomes easier to defend yourself on an audit about pushing some maybe personal expenses that are business, kind of shifting those over a little bit. And that's what we're currently doing right now. You see where we've said at the beginning of the video, we're at Foxwoods Casino. And why are we out here? Did we come out here just to sit on this couch and record a podcast and talk to you guys? No. Is that a part of it? Yes. I don't have a reason to dress up in a suit and look this handsome every single day. So this is an exception to the rule. But we're here to support a client. We have a client that's actually in an event here today. He's a fighter. We're here to support him. And then on another level, we're here to meet with another client to have a dinner with. Mm-hmm. And I can guarantee you we'll be discussing business at that dinner. Now, of course, the entire dinner is not business. I mean, we're people too, but when we have them in person, we're going to cover some things that it's going to be harder to do over the phone. We could do over some nice steak.
Yep.
And some fried calamari.
Tossed.
Yeah. Don't give that one. That is not free advice to get out.
I got to stop with the free advice. I'm too nice. You're decent. I'm nice. Sometimes I'm decent. No, I'm a nice guy. What am I kidding?
Decent at best.
Take it away.
When one's a good cop, the other's a bad cop. I think we're pretty good about that, but you guys will learn that firsthand. So point being, one of the strategies is travel and the board of advisors. You've heard us talk about board of advisors. Maybe you haven't, but high level pitch on the board of advisors is you have a business. Let's do a very simple example. I'm talking to a male. He's got a wife and kids. He started a business last year. What we want to do to help push some personal expenses to business is set up the board of advisors. Now, what does that mean? If you look at a big company, they have a bunch of shareholders. They have a board of directors. So that's essentially going to be the same thing for your small business. Yes, you could have a board, but we'll call it the board of advisors. And the advisors that you're going to put on that board are going to be your wife, your kids when they get over a certain age. Let's call it like 13 once they get into the teens. Like, doesn't need to be that, but just an example. Say they got two kids that are 16 and 18. Let's put them on the board of advisors. Let's put your brother on the board of advisors. Let's put your parents on the board of advisors. Okay, my parents work 9-to-5 jobs. Why would I put them on my board? My kids are in high school. Why would I put them on my board? My brother, he is a 9-to-5 employee himself. He's not a business owner. Why would I put him on my board? It's because now when you are all together, you can talk about your business. It could be a few simple questions. You can ask for ideas. Say, hey, this is what I'm thinking. I'm thinking of rolling out a new product. How do you think that would do in my industry? Or, hey, I have $50,000 flush in cash. I don't know how to invest it. What do you guys think I should do? Or if it's you with the kids and maybe there's aspirations there of them taking over your business one day, you're coaching them and training them. You're giving them real life examples like, hey, I was on a client yesterday talking about X, Y, and Z, and this is how I handled it. The reason the board is so important to have established is now that meal you had with them, or like Mike and myself, we're out here at the casino meeting with clients. My board, I have one of my best friends on my board. He's coming and meeting us for dinner. He's on my board of advisors. Now I'm writing off that meal because business was discussed. My buddy's going to have input. Mike's on my board. He's going to have input. So it's audit proofing when you're writing off things like meals, like travel, where the IRS in the event of an audit is really going to hone in on those line items. And if they're tripping some threshold on the percentage of your gross income, like, ooh, you wrote off how much in travel last year? You wrote off $30,000 and you only made 40. That's going to be a big red flag. They're going to come and push back and probably ask a lot of questions, and you're probably going to be considered committing fraud, and you're going to owe some interest and penalties. It's not a road you want to go down, but that's why the board is so important, because when you do take that reasonable travel, as long as it's sort of in line with your income picture on the Schedule C, on the 1120S, on the 1065, if it's appropriate, and you had some trips out to the casino, or you went to Florida to hold a board meeting, You have Thanksgiving dinner with the family who maybe live in another state. Yes, we're going to write off that travel. You know why? Because you're traveling to see members
Right.
on your board of advisors.
Right.
I know that was a lot, Mike. What are some points I
No,
missed?
it's so good. I mean, they're great points. I'm going to take a big step back here. Let's say you're not a business owner that is maybe thinking about getting into business. If you need a brain to pick, or you need to run some things by people, who are you going to call? Most likely, you're going to call your family.
Not Ghostbusters.
Yeah, you're not going to call Ghostbusters here. You're going to call your family. You're going to call your best friends and whatnot, right? Because you want to run things by them. You value their opinion. So why not do the same thing with your business? If you're getting into business or you're already a business owner, why don't you put those individuals on your board of advisors, your board of directors? And now, whenever you sit down for a meal with your parents, with your friends, and you talk business and you get their recommendations of, I value your opinion. I'm thinking about launching this product or this service or X, Y, and Z, whatever it is. And it relates directly to your business, and it proves as like a revenue creation for your business, or maybe an expense or something like that. Then instantaneously, that's a business purpose. They're helping you make the key decisions that you, the business owner, might need a second opinion on. And that's what the board of directors and advisors is for. And it's very important. It's very fun. But the key thing, make sure it's documented. Save the receipts. You have your annual minutes. You type something out. You put the dollar amount. Yep, dinner, travel, X, Y, and Z. You make the note of what you discussed. And then you have your internal documentation. God forbid something happened with an audit or whatnot. You document it. You have the list of people on your boards. And it can be a real lucrative expense for the business, and it's pretty easy. It's pretty seamless. Like Andrew said, you're taking expenses that could be otherwise personal and shifting them over to business. At the beginning of the call, at the beginning of our podcast here, literally said, hey, it's the beginning of November. The holidays are rolling around the sea. Like, we got Thanksgiving coming up. We got Christmas coming up. What better time to have a board meeting? Your parents are coming in, or you're going to your parents. Your friends are coming in, cousins, whoever you want. And you're able to expense 50%, the meals and whatnot, 50%, the travel, you expense that because you are serving the board and the board is serving you. And you're going to be talking business and you're going to be documenting it. So the holidays are a great time to shift some of those expenses that were otherwise personal over to the business. And that's part of the tax strategy. That's a free one. Goodness, we're giving a free one here again.
That is a free one, and hey, it's okay. Sometimes you got to give some to get some.
Yep.
But I love what Mike said there. There are so many caveats on this point right here, and Mike actually alluded to one. So yes, we're saying, hey, yeah, when you're doing the meals, we're at the casino, we're going to go out to a nice dinner. We're going to expense that through the business, of course. Do not do this every week. Do not only put your wife on your board of advisors and then write off every single dinner you have with her every single night. That's not going to fly. This is, I don't want to say more of a treat, but keep it reserved. I really don't know the pace of how many times a board of directors meets at a big company every year. Maybe every month, maybe every quarter,
Right.
Maybe just sort of as needed. But I can guarantee you it's not every single weeknight, Monday through Friday.
Right.
So let's not get greedy. What's the saying? Pigs get fat, hogs get slaughtered. Let's not. We're not getting.
Good one, yeah.
We're not getting slaughtered here. So that's important to keep in mind. I'm also not saying only do it once a year, but find a good pace. Maybe once a quarter. Maybe Thanksgiving and Christmas, and then maybe another 5 or 6 spread out through the first 10 months of the year. Find something reasonable that fits within your activity for the year, with your P&L. And if you have some smart CPAs like the team here at Ledgerly, Mike especially, incredibly smart, you can see it through the glasses. We'll let you.
I do need to clean these badly. Oh my goodness! All right, that was a little tangent there.
I mean, we'll keep you honest. We'll be like, hey, like probably doesn't make sense to do too much at the year end dinner in Christmas or New Year's because you already have 15,000 in meals and you're only showing
Sure. Right.
60,000 in gross or whatever the numbers are.
Right.
So as long as you're working with your CPA who's helping you implement the board and writing off certain travel and certain meals, have an engaging relationship with them, have them know, like, if you have the right accountant, they're going to be going to bat for you. So they want you to take the write off if they're worth anything, but they also want to protect you at the same time. So that's another caveat that
Right.
Mike referred to. We want to have this all documented. And how do you get it documented? Let's type up something, or let's go to a third party service. Let's get something formalized with your company logo on it and say, board of advisors, the team of the board of advisors includes the following, and then list the names and give them roles. Maybe it's just director, advisor, treasurer, whatever you want to do. But let's get something in formal documentation. So if the IRS was ever to come back to you and challenge it, you have that piece of paper like, hey, yeah, this is my board. And then furthermore on the documentation piece, and especially if you're using QuickBooks, tell your accountant what was discussed. You don't have to repeat the entire conversation, and the entire thing doesn't even need to be documented word for word. But a little summary in the memo in QuickBooks, like, hey, Mike and Andrew met at Foxwoods Casino and talked with client X about A, B, and C topics.
Right.
That should be good enough, but just make sure that's attached to each meal that you have with the board, or each set of travel expenses you have connected with the board. Travel for end of year board meeting with, X, Y, and Z people. And then further on the documentation piece, I'm going to ramble a little bit here. I had another point that I'm going to get to.
Get it? Go for it.
No, we'll get it. So there was the travel, document it, be reasonable with it. What are other caveats I'm not thinking of?
Well, I think you made a good point on the QuickBooks piece that we didn't cover with the bookkeeping. It's a good point, because when you go out for these meals, you go out to the hotels and whatnot. When you get that receipt at the end of your stay or the end of the meal, take a screenshot of it with your camera on your phone, and you can send it to QuickBooks, and it can match the receipt. So it will take the receipt and it will take the bank feed from the credit card or the bank, and it will match it, and it will link it together in the transaction. And in that transaction, you can put a memo. Mike and Andrew stay at Foxwoods for client, we're not going to say our concept, but for client A, B, and C, and X, Y, and Z, and what did we talk about, and what did we do? That's why QuickBooks is a great tool there. But yeah, it's for the board. It's really finding the people that you trust and value. You're not gonna want to have your best friend who you just go to the bars with on a football Sunday and go to the bar and watch the games and drink a bunch of beer and stuff. Are you going to talk business? Maybe, but maybe you're not going to want to put that through the business.
So the other caveat,
Yeah.
kind of piggybacking off that point, we are not putting 30 people on the board of advisors.
Right.
Now, there's no perfect set number, but we typically recommend between 5 and 8 people. This is going to be close family,
Yep.
close friends, the kids. But we're not putting all of our friends on. We're not putting every single cousin, first, second, and third on the board. We're not putting people on that we see once every 5 years. We're putting
Right.
people that are important in our lives, and Mike said it earlier, that we value their input.
Right.
And then another caveat, like, we don't want you to think that this has to be so cut and dry and like, oh my God, I'm going to have a Thanksgiving dinner with 20 people, 8 of which are going to be on my board, and I'm just going to commandeer the whole Thanksgiving discussion around my business and my ventures.
Yeah, right.
We're not saying that at all. Yeah. Don't get all caught up, hold up on that. Let's not worry about that. Like, yes, talk a little bit, spend 15 minutes, or have dinner And then when half of them are passed out on the couch watching football,
or watching the Cowboys lose because
they will lose and they play every
it's
Thanksgiving.
so freaking depressing. Anyways, I digest.
Sore subject. While they're all passed out on the couch, take your board and sit down at the dinner with some coffee, maybe some nice cheesecake. Somebody made a nice pumpkin pie. What's your favorite Thanksgiving dessert?
I love pumpkin pie.
Pumpkin
little
pie?
apple crisp, some vanilla ice cream.
Apple. Talk to me.
Hot.
All right, now you're talking dirty to me. But
Let's go get some steaks.
I am incredibly hungry right now.
Same.
But 15 minutes, but like actually have the discussion, have something to write down so you can document in your minutes, so you can document on that transaction, on that memo in QuickBooks, and audit proof it. But no. I'm not saying when your parents fly out from California and spend a whole week with you that you need to have every single meal with them and it has to be business focused. I'm not saying that at all.
Right.
So just be reasonable. Just make sure you have these discussions and you have the documentation to support it. That is the most important thing.
Yep.
Now I digest. Any last points?
I don't think I have anything to add on the board. Documentation's key.
Yeah, we just want to audit proof it because it's an incredible strategy. And it really isn't that hard to implement, but there is some homework you have to do on your end. Again, we want the documentation. We don't want the IRS to come back in 5 years and challenge your travel expenses. And you haven't thought about that flight you booked to wherever, California, to see your parents around Thanksgiving, and you don't have the receipt. You don't have the memo in QuickBooks where you typed out like, yep, met with parents, discussed XYZ. Like that's all it takes.
Right.
And it's going to take you a minute to type out or your accountant to type out. But you have to be responsible, take control, and communicate that with your accountant, your bookkeeper, so they can record it, document it, and then the IRS loves to come back 5 years past and try and hit you over the head when you're not expecting it. So do it now. Cover your
ass.
Okay.
COA. Yeah, I'm gonna say it. We're a kids podcast, but I feel like COA, cover your ass is acceptable.
Chart of accounts, COA.
Chart of accounts, yeah. Cover your chart of accounts. One last point I'm going to say on this.
Yep.
Talking the other day with a client. Earlier in the year, so we're still in 2024. Earlier in the year, they flew out to see their parents, and the parents flew in to see them, and they had expenses, lodging, meals, and whatnot, that were business related. Now, fast forward to now we're in November, having this discussion with them, and we brought that up, and they're like, oh, yeah. We had these expenses. Well, do you have the documentation? Do you have the receipts? Can you write up a blurb of what you did with them? If the answer is yes, kind of like an HSA, where like if you can match that receipt from prior, then yeah, now you're going to get a business expense. So as long as it happened in 2024 prior, I mean, we'd have to amend tax returns and whatnot. But if it happened in 2024, you can go back from January to now and go through those receipts and be like, yeah, I talked business with my parents, my friends, X, Y, and Z, people that are on my board. So now you're going to add them to your board. And that's that's a cheat code. That's a loophole right there of what you can do.
We love loopholes.
Yeah, exactly. That's a fun one.
Yes.
Love that.
So that's an incredible strategy. You feel like giving out more free advice?
No, I'm done. Unless
you
do.
Are you sure?
I don't know.
I know you want to, and
I'm
you're
a nice
saying
guy.
no for the people. So
unless you have something that I should say. Unless you want to say it.
Well, as it pertains to year-end tax strategy, and this came up on a few consults recently, honestly.
I know exactly what you're going to say.
Yeah. Who's that? We are at a hotel. Please, Mike, entertain the people.
Are we still live?
Yeah. Somewhere else? No, we'll take all that. Okay. All right. You got that, Bob?
Speaking of meals and entertainment, it's housekeeping that we did not order. Or
I took the mic off.
Oh, you did?
Yeah, that would have been great to listen to.
Oh, that would have been great.
Sorry, some I guess just worker. Some hotel employee just offered me an incredible array of booze, but I turned it down because we're on a podcast. We're working right now. We're on the clock.
Interesting. No, we didn't. I was not a paid worker. No, we did not.
No, and we do not have
do
the
that.
booze to show for it because he did roll off with the car because it was not for us. We brought our own because we're responsible.
Damn it. BYOB on this broadcast.
It's going to be all right. It is BYOB.
We will probably cut this out.
No, I'll keep it in.
All right, keep it in. Opus is gonna clip this in and be like,
Probably.
What is this one? I know what you're gonna say. What's our next one?
Okay, so again, just want to highlight there are the difference between tax planning and tax strategy. Tax planning is not just quarterly estimates. It's calculation you can do yourself if you applied it. If you applied yourself, you can figure it out. It's not rocket science.
So you're saying the board of directors and travel is part of tax strategy?
Then there's much more tax strategy than that.
Interesting. So that's free advice.
Am I talking to Francois? Am I talking to Francois?
Francois. Yeah, no.
I thought Mike was sitting next to me.
Francois. All right, I'm Mike now. Let's get into the next one.
So, a lot of people, you get a job out of college or even out of high school, but you go to a job, nice job, they offer a 401k, or you have been contributing to your own IRA for the past 5, 10, 15, maybe 20 years longer. There's two types of retirement accounts. There could be traditional or Roth. Now, we here at Ledgerly and many tax advisors in the space highly recommend having all of your retirement savings in Roth. Now, why is that? You get to pull it out when you're retired tax-free. I don't know about you, but I don't want to focus and worry about paying taxes when I'm just living off my retirement accounts. If you have traditional accounts, yes, they pitch to you. You get the tax deduction in the year of the contribution. So It lowers that taxable income. And it, yes, lowers your tax that year. But do you really need that deduction now? Do you need those tax savings now while you're in your prime years, your working years, when you have the most energy, you can go out. Maybe you could work a W-2 and start a side hustle that grows to its own business. Mm-hmm. You're making all this money. You really want to get a $6,500, $7,000, $7,500 tax deduction this year. I'm playing the long game. I'm focused on my retirement. I want all my dollars in Roth. Mm-hmm. That way I don't have to deal with this tax game ever again. Now, why am I talking about the differences between retirement accounts? Another incredible strategy is Roth chunking. Now, I'm going to defer to my good friend here on what that is.
Yeah, so Roth chunking is, so we say we love Roth because you're putting in post-tax dollars. So you didn't get a tax deduction for it, but then as you get closer to retirement age and you pull it out, you're pulling it out tax-free. Traditional dollars, you're getting the tax deduction now, but then when you pull it out, you're paying tax on basically what you put in plus all of the growth. S&P 500, for example, 6 to 8% growth. So it's compounding until you retire. That's going to be a lot of money that you're going to be paying tax on.
Especially if you're consistent in making those contributions every year, like straight out of college, 22 years old, you make those contributions every single year for 40 plus years.
Right.
You know the compounding effect of interest, you're going to be paying a lot of tax over your retirement years when you're pulling out those funds.
Exactly. So the concept of Roth chunking is essentially taking those traditional dollars that you've already gotten the tax deduction for, whether it's a deductible traditional IRA contribution or a traditional 401k contribution, and you take those monies and now you convert those to Roth. However, it creates a taxable transaction because you got a tax deduction in the year that you contributed to it. So Roth chunking, it's going back to the last podcast we did, it's almost a work of art, like Andrew said, because what we want to do is we want to make sure that the monies that you're converting from traditional to Roth aren't pushing you into the next tax bracket. So tax brackets go from 0, 10, 12, 22, 24, and so on. That 12 to 22 is a huge gap. And then after that, it's 24 to 30. I should
32,
32, 30, something like that. There's some big, when you look at the scale of Roth chunking, which we would have to go to the whiteboard on and draw it out, there's some big gaps. the one from 22 to 24, okay, 2%.
We can live with that.
We can live for that. We can live with that. And if it's going to push you in to that 24% tax bracket, you're only going to be paying that extra 2% on the monies above. That's one misconception a lot of people have, is they think that all of their income is now taxed at 24.
The income tax bracket, it's a sliding scale.
Exactly.
Whatever the numbers are, I don't have a table in front of me. Maybe I should have this memorized, but it's fine. You could look it up. The first, let's say, 10,000 or 15,000.
Yeah, the standard deduction.
The standard deduction taxed at 10%,
right,
give or take, and then the $15,000 to the $60,000 is taxed at 12%. Then the 60 to 120 is taxed at 22. Again, that big jump. It's only for whatever's in that income bracket is taxed
Correct.
at that rate. So it's a sliding scale.
Correct.
So the Roth chunking, like Mike was saying, you go to your tax advisor and you say, like, hey, I have this income for the year and I want to convert $50,000 of my traditional IRA. I want to convert that to Roth. You know Roth chunking.
Right.
You know how important it is to get those into Roth dollars so it can continue growing tax-free. And then, like we said, compounding effective interest, that money's going to grow and grow and grow. And then when you're retired, there's no tax on it.
Exactly.
So with that $50,000, you're going to go to your tax advisor and you're going to say, I have $100,000 and I want to convert 50. They're going to take a look at your filing status and the income brackets, and they're going to be, hey, okay, you can convert $25,000 before you get into the next bracket. So you're not going to convert all $50,000 that year because you don't want to pay that extra 10% in tax on that $50,000. So we're going to be, okay, let's convert 25 then. And, yes, you're going to pay the tax on that, but we don't want to pay that extra 10% on that other 25 if you were to convert that.
Exactly.
Concept being, like Mike was saying, the conversion is a taxable event. But the traditional IRA distribution, when you're retired, that was going to be a taxable event as well. So we're just pushing it up now before it grows to an astronomical dollar value in your account. We want to pay the tax now, so we're not paying all this tax on a much bigger and larger balance when we're retired and we're living off that money, and that's our primary needs. That's why it's so important to convert and chunk now.
Yep, beautifully said. Well said. So chunking, huge, taxable it's a taxable event. However, when you have a good advisor like Andrew and myself and your team at Ledgerly here, we'll be able to put it pen to paper on the whiteboard. Okay, you're a single individual, you're making X amount, and you have X amount in traditional dollars. How much can we convert in order to keep you below that next big spike in the tax bracket? Now, we're not going to beat this one to death, but now you're doing really well with work and you're making a really good amount of money. A lot of people will say, oh yeah, you can't do a Roth contribution anymore. That's BS. You can do a backdoor Roth contribution now, which we will get into. It's more pen to paper, more whiteboard discussions.
That's an advanced strategy that a lot of CPAs don't know about. I mean, I'm going to be honest, we didn't know about this 2 years ago.
Yeah. I mean, you hear about it, but you don't understand. You understand how it works, but you don't understand what has to happen before in order to do a backdoor Roth. So, just to kind of, I'm not sure if you want to.
No, that's a little teaser, and that's why you should get in touch with us, because chances are your accountant doesn't know about this, and again, listen, it's not going to apply to everyone, but if it is you, chances are your accountant doesn't know about it, and we can help you out.
Right,
we're here for you. But yeah, that's a little teaser, the Mega Backdoor Roth. Honestly, if you want to hear more about it, I'm happy to plug where we get a lot of our training from, Mark J. Kohler. He does incredible videos on this on his podcast, and we speak his language. We implement his strategies. We're in his network. Incredible tax advisor. But to circle back on the Roth chunking.
Yeah.
I know I had something to say. It'll come to me. But I know I did want to circle back. So we talked about it's a taxable transaction. What else was there? So upon the conversion from traditional to Roth, like I said earlier, yes, it's a taxable transaction, But when you're doing it at 30, you might be like, oh my God, like now I got to pay the penalty because I'm taking it out before I'm 59 and a half. No. Relax. A conversion is not subject to penalty. Just like your distributions after the age requirement is not penalized. If you're taking it out to go on a trip to Foxwoods and take out some friends and gambling it on the casino floor, all right, yeah, you're going to pay a penalty on that if you took it out way too early and it had no merit and it didn't meet one of the exceptions. But if you're converting it to Roth, it's penalty free. Yes, you're paying the tax on that, but we knew that. We want to pay the tax now opposed to later.
Exactly. That's a really good point, because a lot of people will say, "Oh, if I'm converting it before retirement age, what's going to be the penalty?" Well, no, you're going to pay the tax, but penalty. But yeah, I mean, this is a loaded gun that we're playing with here. There's so much that goes into.
Oh, you want to talk about loaded guns?
Yeah.
Like not actual loaded guns. Sorry, do you have?
No, go for it.
If you've heard this guy out there, I can't remember his name off the top of my head, but he pretty much demonizes debt.
Oh,
and says it's a loaded gun.
The fellow bald individual with glasses, Mr. Ramsey, Dave Ramsey.
Is he bald?
Good guy. I think he's got maybe a white crown.
Okay, white crown.
He's definitely bald at the top.
Okay.
Yeah.
I'd love to sit here and keep giving you guys free tax insights, but we do have an incredible dinner to go to.
We're getting to.
But yeah, so loaded gun, debt. I'm not going to sit here and say all debt is bad because I don't believe in that. But if we're going to talk about consumer debt, or reductive debt in general, I would say, yeah, you don't want to have that. That's doing you no good. What? So you can have something cool you couldn't afford. You buy it on credit and you think you're the man for a day, 2 days, a week, maybe if you're lucky. Don't go around putting yourself into debt for things that you do not need. And this is one of our top 5 things that you want to think about before year end is your debt picture, both on a personal level and a business level, because there's 2 sides of the coin. Again, loaded gun. It could be bad, but it could be good. Do you need to purchase a $100,000 asset that's going to improve the operations of your business and you can't afford it, so you take out a loan? All right, if it's going to increase your income, by all means, do it. Yeah, absolutely. I'll say it.
Yeah, 100%. I mean, Dave Ramsey, we love his debt snowball approach.
For the personal income, for that reductive debt.
Exactly.
And it's just sitting around. It's not doing you any good. It's just accruing interest. Yep. You're making the minimum payments, and you just have this incredible debt picture, and you don't know how to get rid of it.
Yep.
The snowball is an incredible model to follow and implement to get you out of debt faster.
Exactly. And for the listeners, that type of debt that doesn't add to your top line, that doesn't produce revenue generating transactions for the business. Consumer credit card debt, maybe some student loans, a personal car loan, a boat.
And can I carry on that a little bit?
For it.
So, and of course, I don't want to say student loans are reductive or unnecessary. Maybe you're in a profession that you really need a college education for, of course. I mean, that's why you go for any major to ultimately get a job, right? But I mean, there are some certainly that require a second layer where you got to go to grad school, to become a doctor, or you want a master's in tax. And there's some other ones, or you want to be an attorney. All right, you're probably going to incur a lot of student loans. But at the same time, it's helping you land that job or open your practice. But now it's sitting around and now it's not doing anything for you. Let's get out of that.
Right.
It's got no purpose for you. So let's speed up these payments. And what the debt snowball is, if you ever have the opportunity to work with us, you get on a consult with us and you have a bad debt picture, we'd be happy to share it with you and coach you through it. But the concept is you increase your payments, you consolidate a list of your payments, you commit to paying more than the minimum. Let's just put any sort of number out there, right? You say, okay, you know what? I got some good income. I got a side hustle. I got a W-2. I'm bringing in good money. I'm going to put another $2,000 onto my debts that I owe.
Yep.
You're going to apply that to one piece of debt at a time. So if your minimum payment was $150 on a credit card, now you're paying $2,150. You're going to still pay all the minimum payments on all of your other debt. Like said, student loans, auto,
credit cards,
other consumer credit. Yep. but you're not gonna. Chances are you can't put an extra 2,000 on every single payment.
Right.
So we're gonna do one at a time, and we're gonna speed up that process, because if you just do the minimum payment, a lot of the way they're structured is they'll be paid off in like 5, 10, 15, 20 years just doing the minimum payment, even if you never used them again.
Right.
There's no reason for that. There's no reason you can't get out of it earlier. We don't want to pay all that interest. Let's get it out of the way now. So you apply that extra 2,000 to the first debt. You commit to it. Do it every month. 2150 one month, 2150 the next month, 2150 the third month, and then maybe it's almost gone. Do it until that one's gone. Once that's gone, you're going to apply that payment to the next debt you have.
Right.
And it's not going to be the 2,000 that you committed to overpaying. Now it's going to be the 2150, your previous minimum payment, plus the 2,000 you committed to overpaying on that debt. And then you apply that to that next credit card, that next student loan, and you do the same process. Maybe it takes you another 4 months. And that minimum payment was, let's say, 300. So now your payment on that was 2450. Sorry if I'm talking too fast. Go back and slow it down, but follow the math. So then we're doing 2450 for a few months. Then we pay that one off. Then we roll that to the next one, and so on and so forth. It just speeds up the process and ensures you're not paying an egregious amount in interest. You're going to feel incredible. It's going to be a weight lifted off your shoulders, and you could shift your focus from getting rid of this nasty debt and focus on growing your income, growing your investments, growing your retirement accounts.
Right.
It's a very powerful tool.
Right. And that's a common question we get is like, oh, I want to focus on real estate and investing and ROTHs and HSAs and all this stuff. We go, oh, pump the brakes. What's your debt picture like? When should we
Put it in reverse turn.
Yeah. Hang on. Pump the brakes. Let's cut the ball and chain off the ankle, meaning the debt that is not working for you, but it's working against you. And then let's come up with the picture for the investments. And then to freaking further it, if you're a business owner, let's get into debt that's going to work for you. A new vehicle, a new piece of equipment, maybe a line of credit that you can draw on that's going to help you in the business and increase your revenues. That's going to work for you, not against you. So yes, loaded gun for sure, because a lot of common misconceptions with debt. Is it good? Is it bad? Should I take some out? Should I not take some out? It all depends on your picture, personal, business. It's there's a lot that goes into it, and these are the services that we can help you with, which is the beautiful thing. And we put your mind at ease on a lot of the stuff. So it's incredible.
Absolutely. So if you're in personal debt, consumer debt, reductive debt in general, highly encourage you to talk to us. Go search on YouTube, Dave Ramsey. He'll explain it in further detail. Mark J. Kohler is an incredible resource. You want to come on to a comprehensive consult with us, we'll go over more than just tax strategy. Like Mike said, we'll bring it back and go into the personal picture, talk about your personal debt and what are your issues right now. But it's up to you. You got to take control. You don't hide. Don't put your head in the sand and hide from it. Attack it. Be the owner of it. And let's, like Mike said, let's get rid of that ball and chain. But we have incredible resources, and there are incredible resources out there, but it's up to you to reach out to them. You can find us on Instagram, Facebook, TikTok, X, YouTube. YouTube especially, we have so much content up there. Please listen to the podcast, click on our shorts, like them, leave us comments, send us messages if there's anything that is really important to you that you want to hear more on. Again, we're here for you. We're giving out this free information because we want to help you guys. And there's so much more than we have time to sit down for an hour and speak about. So let us know what's on top of your mind, and we'll start rolling out videos that are more catered to you. But thanks for tuning in, and catch us next time.